I believe we have Simone Beaty, who's going to be taking the microphone next. Simone is the Senior Director for Affordable Lending Product Development at Freddie Mac. Simone, are you there?
Yes, I am. Can you hear me?
We can hear you loud and clear. Please jump right in, introduce yourself, and we'll take it from there.
All right, thank you, and good morning, everyone. As Nick mentioned, my name is Simone Beaty. I am currently the Senior Director at Freddie Mac, managing affordable product development, for which energy efficiency products is one of those areas of focus. And I'm going to spend time today really talking about our journey around developing an energy efficiency mortgage product on a single family realm. And also kind of talking about not just the journey, but basically kind of how we are faring in that space, the challenges, and then also the opportunities that we see ahead, and kind of what we need to kind of grow the market on the single family residential side. So in terms of energy efficiency, primarily in the single family mortgage realm, about 5 years ago, I think roughly around early 2016, we wanted to focus on being strategic rather than having just a general mortgage offering that we can essentially market in this space. We wanted to tailor a product that was more surgical, more direct towards incentivizing the lending community to go and source and seek out properties that could be improved to have some energy or water efficiency, and use our products essentially as the financing tool. We had on the multifamily side, we had already launched our Green Advantage suite of products that essentially aims to provide financing to reduce energy and water consumption. We wanted to kind of mirror that on the single family side. And so we deliberately looked at where do we start first, right? So for us, as we looked at the market, new construction standards were evolving as more and more states adopted more energy efficient codes to build. And we recognized that the existing homes and the affordable supply of existing homes was a bigger nut that we had to crack. It had the ability that if we did tailor a product, we were impacting a larger subset of consumers. Most of today's existing housing supply is in need of some sort of rehab or renovation, according to the joint Harvard studies for housing. About 80% of the existing home supply is over 20 years old and is in need of some kind of renovation, right, or updating. And that number will only increase over time. And so we feel that as a segment, it was the area we should focus on first and tailor resources and products towards the existing home supply, especially because I sit in the affordable realm. We also can, have the biggest impact on consumers that have incomes with low and moderate income, in terms of the segment that they are already cost burdened. And to the extent that we can have a measurable impact on kind of reducing their monthly housing expense through utilities, which is typically not an area of focus, especially in underwriting standards, we think that between the overall subset being larger for the existing homes and the consumers that could be served, this was the right area of focus. And so as we looked at the market, a few things cropped up as we endeavored to figure out how do we tackle a product that lenders can actively use. And the challenges we were staring down were significant. One was it's an emerging market, right? And it's hard for a lender to see scale when really there's hardly any lending happening surgically on the residential first lien mortgage side to support financing for home improvements, specifically for energy improvements. Energy and water efficiency was not top of mind when we started the exercise for most consumers. And most consumers actually taking up the opportunity for financing at that point in time was not considering, the mortgage process, which can be a lengthier process, rather than getting, an unsecured loan or using their credit cards and cash. when they're talking to a contractor, it's just not the first solution that they go to for financing. And then additionally, as we thought through, well, you have this consumer not thinking about it, you also have a lender not thinking about it. On the lender front, in order for us to essentially build out a green product, we knew energy assessments would be important part of that for us to have some measurable threshold to look at for efficiency. Lenders out the gate, we knew if something's niche and if the market is not readily apparently large, they're unlikely to build out a process to support it because they can't see the opportunity in front of them. So as we undertook, product development, we felt it was important, even though data was hard to come by. Data is the other challenge we were staring down. Is data on the single family front is also not readily available. But we felt if we could get enough data to put some transparency to the market at the same time that we are releasing a product that could help incentivize the lending community to take a fresh look at this business, that will be helpful. So one of the things that we did do in parallel with product development is we did some research and analytics. We put out a white paper in 2019 that essentially endeavors to look at the correlation between properties that were rated for efficiency versus properties that were not rated for efficiency, and what was the impact to essentially the value of those properties. Did they have a better value, same value, lesser value, or basically negligible? Or and also looking at mortgage performance, right? To the extent that we have in our own portfolio mortgages of homes that are rated, and we can use data to reconcile what's rated, and also leverage information that we can collect through the credit bureaus on mortgages nationwide to the extent that they're rated, kind of what the attributes were on those loans and those properties. And so, without going too much into the white paper based on the time we have today, essentially that analysis resulted in us basically going to the Department of Energy to use their home energy score index, and also going to ResNet, who has the home energy rating system, or HERS index, both index rated models where they produce a score, unlike the certifications that is essentially pass fail, where you get a certification if you pass. We felt it was easier to essentially explore the data through the index that basically gives you a threshold of where the home is in terms of the rating and what the rating means. And as we looked at a sample nationwide based on those two indexes, noting that ResNet had the larger volume of homes, we actually were able to form conclusions on the data that we looked at. And we isolated certain variables such as loan to value ratios, the sales history on the property, the mortgage payment history, debt to income ratios, the loan type and purpose, things like that. And what we're able to form in terms of conclusions were three things. One is homes that have an energy rating versus homes that do not actually sell for more on average. And it was approximately about 3% more in terms of how much more in comparison to a comparable home in the same market that was not rated for efficiency. The second result was the better the rating in terms of efficiency, the higher the sales price on a home on a resale. So what we saw based on the random sample that we had was that reflected about 3% to 5% more in terms of a sales price on average than a lesser rated home. And then the third result that we were able to get out of the analysis is as we isolated certain characteristics on the mortgage that we were analyzing, one characteristic stood out from the population of rated homes as we were comparing them to unrated homes. And that was the debt to income ratio. And that one was pretty telling because we had a hypothesis that if a consumer is putting kind of more, skin in the game essentially to improve the property for energy efficiency, and they're reducing the amount of cost that they're spending on utilities as a result, there's a chance here that it's possible they could outperform their peers in that market, to the extent that other consumers in that market with a similar home is not doing the same activity. There's more invested here. And when we looked at the high debt to income ratio category, and that is ratios that are 45% or more in terms of the debt to income ratio, the back end, they had a lower delinquency rate than unrated homes. And for us, that was pretty compelling. And luckily for us, we did the research in the middle of product development for what became our Green Choice single family mortgage product that essentially lenders can use to finance improvements. So what we did is we took kind of the value of that research and actually it was helpful for us working with our risk folks to drive decisions on maximum loan to value ratios, what special features we put in the product, how streamlined can we make the product if we're saying, hey, lenders typically don't use the mortgage for this purpose, so we would need to incentivize, operational lenders to use it as a home improvement or a rental product. How streamlined can we get beyond a full-blown comprehensive renovation product, reduce some of the operational burdens? And it was quite helpful to have the research on those points, because we were able to put to market in 2019 a product that is essentially a streamlined version of a full-blown renovation product, where lenders are not holding recourse. They're not setting up, the full-blown renovation activities that they would need on a full-scale renovation product. By and large, because we limited the amount you can finance, basically for what we see as kind of average cost on expenses for items that typically are green. So what we did is we rolled out a product with two paths. One is to tackle the renovation piece, meaning that you're using the mortgage proceeds to essentially fund activity that will happen after they go to settlement, right? So essentially, we will purchase a loan where the renovation activity hasn't occurred yet, right? And that is up to 15% of the equity of the home, or the as completed of value of the home, can be rolled into the first mortgage lien to essentially fund future improvements, right? The second path to it is around consumers that had already taken on, the expense and or debt burden of financing, maybe through more expensive financing solutions, credit cards, right? Is one in terms of where a mortgage could be a solution to pay off that debt. And we said, okay, lenders, we will allow you to use our first lien mortgage to pay off debt already used for this purpose, up to the 15% maximum on the value of the home. And we will allow you to take advantage of the no cash out provisions in our mortgage requirements to pursue that debt payoff. Ordinarily, we would have treated those transactions, if you're paying off debt that is not the existing mortgage, it's treated as a cash out transaction. The pricing is usually higher because it's an equity extraction. The loan to value ratios are typically lower on a cash out refinance, but we wanted to be able to maximize maximum loan to value ratios for equity extraction for this purpose, again, to incentivize both consumers and the lending community to use the first lien mortgage, which was not used by and large at that point in time. And to the extent that we were asking for an energy assessment on the property so that consumers have an understanding of kind of where they sit pre-post improvements, we recognize that there was a cost both for the consumer and for the lender to take that on, right? So there's the cost of the energy report. And then also the lender has to make sure that they are managing a process where they collect, request and collect that report. And so we added an incentive to the pricing of the product to make sure that there was an offset so that both lenders and consumers aren't burdened by actually going out to get an energy assessment, which we feel was important over time so that consumers can understand how much savings that they're getting from the improvements that they're making over time, and also to understand how much efficiency that they're gaining on the property and what that means to them. And also, consumers can use an energy assessments today to essentially, pursue rebates, any federal incentives that they may be entitled to, depending on what type of improvements that they're putting on the property. And in terms of how we're faring on this, so it was slow going in the beginning because I think our last presenter mentioned there's not a whole lot of awareness on the residential side of financing solutions for energy and water efficiency. And so, we released the product in 2019, but we really didn't see any pickup until 2020, right? And so we made changes to the refinance portion that allows that no cash out feature in late 2019. And the wind beneath our wings really was the low interest rate environment where lenders recognize there are consumers out there that are making green improvements that already has incurred, they have incurred the expense. And if they're going to refinance a mortgage, now is the time to see if we can source some of that business if consumers are already looking to refinance and lower their interest rate on the first lien mortgage. And so we saw a lot of pickup in 2020 on the refinance front for that purpose, for debt payoff in particular. And the improvement type that we recognized a lot of volume was for payoff of solar improvements. And so for us, solar or any renewable component does kind of meet our goals, kind of our overarching goals at the beginning of the exercise was to not only provide financing, but also preservation of the property on the affordable side through utility savings, but also to reduce our overall carbon footprint. If we can kind of incentivize, consumers using our product for renewables and other improvements that dramatically decrease their energy usage, that for us is a huge win for the market overall, to grow the market, and also for consumers that are already kind of cost burdened with the housing expense, where that is trending, nationally. We have an affordable lens to basically try to tackle that as an issue in terms of housing supply and affordability. And so seeing that volume come through in 2020, where we recognized or realized, approximately about 450 million in aggregate, mortgages coming through, that basically a lot of the volume was for solar improvements, was a huge, success for us in terms of getting usage and getting usage for the right purpose. So in terms of our outlook, what we see is we think that with more companies and more investors having ESG groups, so the environmental, social, and governance groups within their companies, they're now starting to pay attention to this segment on the single family side in particular, whereas before it may have been an afterthought. With an increase in homeowners, especially with the pandemic, looking to do home improvements to their home, and they're starting to actually evolve and also take into account energy improvements as they're making upgrades. I think with the current interest rate environment and a little bit more focus and awareness on the consumer side, the investor side, and the lender side, I think this market has an opportunity to grow a lot faster than it did 5 years ago. And so I think the momentum is there. The biggest challenge, I'll close out with this, the biggest challenge we still face though is standardization. We still are not in an environment where there's a whole lot of data readily available and standardized in a format where everyone can interpret the data the same on single family energy efficiency and what that data means. Right now, the data means something different to everyone that's looking at it to the extent that data is available. So data standardization is going to be critical. It's going to actually critical and necessary to scale and grow the market and for us to trend performance for us to kind of show the picture on the opportunities, for us to be even more surgical and fine tune a product beyond what we've already released. That is going to be necessary on the go forward. And with that, I will close out my remarks.
Simone, thanks so much for your time and for that excellent conversation.